You're still muted, bro.
Still muted. Guys, we've talked about Gabriel before. When we first started doing deals in Lawton, Gabriel here, he was our contractor. He was kind of our go-to guy. We were kind of wholesaling a little bit with him, kind of doing some remodels. But over the last few years, he's become a full-fledged landlord and investor. And we've talked about you a lot on here, Gabriel, about your story, kind of getting into rentals and all that, pivoting away from just being how you put it, day laborer, basically. And now you're one of our bigger buyers in the market. And so Gabriel here, he's an admin in the group. If you got remodel questions, you guys can always at him and ask him questions. But yeah. All right, we'll give it about 2 more minutes and then we'll get into it. All right, 7 of you guys. Sweet. So is he selling the cars to get the deal?
That's what Gabriel says. He's selling the McLaren to buy the apartment, right?
Gabriel's your investor selling those cars still? Oh, where'd he go? Gabriel's really good for us sometimes bringing investors in to buy certain deals. That's kind of what he started as, and then he started buying his own deals. But he has an investor right now who might potentially be selling off some cars to buy an apartment complex off us, but we'll see. We'll find out more from him. All right, 1 more minute, guys, and then we'll get to it. Hey, Harold. Sweet. So can I turn people on or off? Okay, sweet. 1 more minute. And also, you guys, just feel free to fill up the chat room. Oh, you need permission to unmute yourself. That's why. Sorry, Gabriel, didn't see your message. Pin for everyone, kick, allow audio. There we go. Allow video. All right, you should have permission now, Gabriel, but we'll bring you on at the end.
Allow audio.
Okay. Now I think can you guys hear me now?
Now? Yeah, I think we can hear you now.
Mm-hmm. All right, awesome.
All right. But yeah, we'll get you back on here at the end. Today's itinerary, we're going to be talking about the loan product we use for buying our rentals, and then we'll break down one deal in our market. We'll check out one of you guys sent us a deal that we will break down. It's an Indianapolis deal. We'll break it down, and then after that, we will get into the Q&A. Perfect. 7:05 on the dot. So the loan product we use, DSCR loans. I'm going to talk about DSCR loans. I've updated the module in the classroom talking about DSCR, but what I'm going to do is, he's going to queue up the address, but I'm going to just kind of talk to you guys about why we use DSCR loans and what our experience was before we got into DSCR loans. So we bought our first deal 3 years ago. We bought it with cash from wholesaling. And our idea when we went into the deal was that we were going to buy it, remodel it. It's going to be worth more. And then we'll go to the bank like everyone always says. That is something I have become really frustrated with. A lot of these influencers, people teaching real estate investing, teaching the BRRRR method. A lot of them just say, hey, buy a house, remodel it, and then you go to the bank. That is what screwed everything up for us, the go to the bank part. When you go to a bank and you're 20 years old, you have no tax returns, no income, what are they going to tell you? They're going to tell you, first of all, they don't care about the property's income or the property's value. They're going to be like, you're 20 years old, you're an idiot, you don't have any income, you don't have any tax returns, I'm not going to give you a loan. The second thing they'll tell you is, you haven't owned this property long enough, we are not going to loan on it. And that's what happened to us. We thought it was just the bank we were going to. So we went to the first bank and we ran into that problem. Went to the second bank, ran into the same problem. Third, fourth, and we kept running into that. And I just remember being really frustrated because that's what everybody says to do with the BRRRR method and all the real estate gurus, whoever you look up to. What are you doing? Oh, yeah. That's always what they say is just go to the bank. However, if you go to the bank and you don't have a strong income, strong tax returns, or haven't owned the property for at least a year, they're going to give you issues. So the thing that really changed everything for us and allowed us to scale to so many doors so quickly is a DSCR lender. These are lenders that loan based on the property's value and the property's income and your credit score. That's it. They also have way more flexible and creative loan products that have no seasoning periods. So what we did is we called up the biggest investor in our market, Gabriel. You'll know who I'm talking about, Mr. Patrick Rigg. And we were like, dude, what do? We can't get our cash out of this deal, and we want to buy deals like you do. And what he did is he connected us with his girl, Trishelle, DSCR lender, and we got on a phone call with her. And what's so great about DSCR lenders, they're commission based. So when you get on a call with them, they're immediately trying to hustle and solve your problem because that gets them paid. When you go into a bank, there's this term called relationship banking, which is basically we are going to change how good of a service we give you based on how long we've known you and our relationship with you. It is ridiculous. It's really frustrating to work with, but with DSCR lenders, they care about getting that loan closed. So as soon the first phone call we had with her, she was already like, hey, send me the property info, send me everything you got, send me your documents, like let's get this going. I'll pull your credit. And she was already trying to figure out how we can close this loan within the next 2 weeks. And that was fantastic for us. That was a huge relief because we tied up at the time. We put all the money we had because we bought it in cash. So quick side note about funding your first real estate deal. I was talking about about a week ago about hard money versus buying your first deal in cash. A lot of people ask me, how much money do you need to get into real estate? Well, that answer changes depending on what your goals are and what your expectations and what you need out of real estate is. So the reason why I blanket prescribe people to save up enough cash to buy their first deal in cash is because every single time I see investors do that, those are the investors who scale to 5+ units in like 12 months and have the strongest cash flow and are the ones who can scale to 20, 30, 40, 50 unit portfolios in under 5 years. The investors that get slowed down are the investors who over rely on using hard money or private money to buy.
Or zero cash down.
Or zero cash down, because there's a cost to that. When you go to borrow hard money, there's a cost. There's points and it's higher interest and it slows things down for you. So the more cash you have going towards just paying for the short-term debt you use to control and remodel the asset, the less cash you have to actually invest in deals and scale your portfolio. So it may take you longer to get in your first deal, but you'll go from deal 1 to deal 10 so much quicker. But it's
let them know that you're reusing your initial investment.
You're reusing, exactly. It's called recycling capital. But I do want to say, I don't know if he's on the call, but Yug Patel, he did enlighten me a little bit because Tony and I are full-time investors. This is all we do is investing. So of course, that is what we believe makes sense. But Yug, he actually came out to Lawton. He visited. I'll post his house sometime and talk more about it. But he brought up like, hey, I work a full-time job. I do my tech sales, and my first deal is like, I don't want to make a mistake and, lose all my cash I put in. And I had a good talk with Yug over breakfast. It was actually really good. Babs was there and everything. And he actually enlightened there is a scenario in which not buying your first deal in cash makes sense. And it is contingent to your expectations with real estate. If you expect to be able to retire with real estate in 5 to 10 years, let's say 5 years, you expect to be able to do real estate full time in less than 5 years, you got to buy in cash. However, if you're wanting real estate to be your thing that grows you generational wealth and is how you retire, say in 5, 10 years, or is just a diversification of your investment and cash, using hard money, like the loan product I know Yug is using, and Shemaya, I hope I said that right, and Amanda are using, if you do the math on what their cash is earning. So I broke this down with Shemaya. we had a call last week and we broke down like, hey, her cash investment, she'll be roughly cash out of pocket on a deal like 7,000, like less than 10 grand. But the return she earns on that cash, just looking at the cash and what she returns on the cash flow, we calculated at Shemaya, I think it was like 15%, which is fantastic. That beats the market. That's about what the S&P does on a really good year. And even better, she's getting the debt deflation. And also, because of inflation, debt deflation, so leaving out the debt actually getting paid down, the fact that the debt amount stays 100,000, it stays the same, and the value of a dollar is going down, that's also building. That's not even factored in that 15%. And we broke down the other benefits of real estate, even though she's not buying it 100% in cash and scaling to 5-10 units in 3 years. The loan product that she's using, that yes, you're paying, it's more expensive. It's still a fantastic investment vehicle to be wealthy. And so I've kind of tweaked my advice a little bit, whereas it might not be realistic for everybody to buy their first deal in cash, but just have your expectations in line with the fact that if you are wanting to be a full-time investor, like in less than 5 years, the route you'll need to go is trying to get to buying in cash full. Whereas, you work a full-time job and you just want to, hey, in 10 years from now, I don't want to be doing it. All right, just change your expectations to be in line with your investment strategy. So I have a little bit more of a balanced perspective, and I see value in both loan products. And
it makes sense too if people are working a full-time job and they just want to have a property every year, a property every 6 months to just put X amount.
And you're gonna be beating the market, even if you're just looking on cash flow. You're beating the S&P. If you're looking at like the debt deflation, you're beating the S&P, and then like you have the appreciation. So it's just still, even with borrowing really high interest debt and doing the product that Shemaya is doing, where she's only gonna be out of pocket 10 grand and she's in on a probably like $130,000 home. It's still fantastic. She doing this strategy, a house a year with the loan product she's using, she'll be very wealthy, even without buying her first house in cash.
You have an asset, and then eventually it'll
be paid off. Eventually be paid off. And you do a house a year, it's paid off in 10 years. You got 10 houses, like you're a millionaire.
And even if you do a longer loan product, like you're still going to be very set up by the time you're, say, 50 years old.
Exactly. And that's the thing, is like, okay, she's able to do a house right now with $7 grand out of pocket. Let's say best case scenario, the appraisal comes back better and she's $0 out of pocket. But even worst case scenario, 7-10 grand out of pocket. She, let's say, keeps going about her career and gets starts to increase her base income. Okay, now she can do 2 houses a year, only spending 20 grand out of pocket. In 10 years, I mean, you're worth 2 million, 3 million, 4 or 5. Yeah.
People that are investing like this, they're also putting money aside, say in S&P or their IRA, so they're getting
diversified.
Double of it, which is really nice.
But anyways, before I digressed on that, as far as deciding which it fits for you, DSCR, regardless of which method you're going to go, buying in cash or hard money, your DSCR lender is your plug for both, because a good DSCR lender has a good network of private money lenders and hard money lenders. And those are basically people who will lend on you with less optimal terms and like less requirements than a bank. They'll be expensive, 12 to 15% interest. But a good DSCR lender is able to structure the private and hard money into getting you your purchase price and remodel. And then they have a system for getting you into the refi in the back end. So let me talk through all that. So if you're going the route where you're buying a property using hard money, this is what it would look like for you on the lending side. You purchase a property, purchase price and remodel, you're using hard money. This could be a individual that they say it's putting your money on the street. Basically, they're lending it, they're coordinating it with, say, the DSCR lender. The DSCR lender is coming to you being like, hey, we will fund your purchase price and your remodel, and here's what it'll cost. It'll cost you some points up front, points on the back end, and it'll charge you interest for the time you're borrowing that money. What is that time you're borrowing the money? That's the time of you owning it and remodeling it up until the remodel is done. Because when the remodel is done, you are refinancing it with a DSCR loan, and that'll be a 30-year loan. So you're using the hard money, private money, short-term expensive debt. We're talking 12, 13, 14% interest with points. You're using that debt just to purchase the property and remodel it. And then the DSCR lender, they are doing the refinance and putting it in a 30-year loan, something between you'll get 6.2% to 7.2%. Compared to the hard money, that's great. And that's the loan you will keep on the property for the life of the loan, and is what you ultimately are going to be underwriting if you use the deal calculator that's in the schoolroom. That's what you're looking at for the long-term performance of the deal. And that's why it's okay to use the expensive debt for just purchase and remodel, because you're only going to be using that debt for 3 months. You're just using it long enough to, they say, control the asset, improve the asset, so now it's worth more. And then that's when the DSCR lender, a more traditional lender with higher requirements, just as far as like the property's value, condition, underwriting, so on, so forth. You're just using it long enough to get to there. And then that's when you get the 30-year loan that you just set it and forget it. And that is the most common life cycle we've been seeing people use with our DSCR lender. So real quick, I'm just looking through the module. I'm just looking at any of the stuff I threw in here about our lender. No seasoning loan period. Very important. Find you a DSCR lender that has a no seasoning loan product. Typically, it'll just be on the property's value being over 100,000 and getting a lease in place. DSCR is debt service coverage ratio. They're looking for the property to be able to cover the debt. So what they're looking for is, say, if the rent is $1,000 a month, the monthly mortgage payment cannot be more than $1,000 a month. A lot of lenders have a DSCR ratio of 1.2, meaning rent has to be 1.2 times the monthly mortgage payment. So if it's $1,000, let's say it's $800 a month. Wait, let me do quick math. All right, if it's $1,000 a month mortgage payment, your rent's got to be $1,200 a month to have that coverage. That's what they're really looking for. And then the actual process for going back and forth with the lender. Let's see who's all in the call. See who any of you guys are doing a loan. Yeah, Sean gets it, but Mr. Sean Flick on here. And who else is Amanda? You probably have some experience with that, but Gabriel too. Well, he hasn't done any loans with Rochelle.
No, not with her, but he's done loans with other lenders.
Yeah, but the process, it's going to be different. Honestly, it's almost different every single time as far as what the underwriter cares about for getting the loan. So here we are, remodel's done, and you're trying to get a loan. Sometimes just a signed lease is good enough for underwriting. A signed lease that shows this place will be bringing in rental income. Sometimes they need proof of rental income. So like bank statements, something like that. And then your credit, they're always going to have to pull your credit. It's good for 90 days. So if you can, every time they pull your credit, it can hurt your credit. And so we've been noticing, we try to line up our refinances so we don't have to have our credit pulled
all at one time.
So they'll check your credit. Sometimes underwriting may need bank statements for a few months, not tax returns, just bank statements. And really what the underwriting process is like is that they are trying to figure out, first of all, they're trying to verify the value of the property and the income of the property. And then depending on the underwriter, the stability, reliability, and experience of the borrower, most of the time, it's just credit score. And then if they have questions about specific mortgages the borrower has, that's as far as it's gone. I've never been asked for a tax return or personal income statement, nothing like that. Nothing about other properties we own. Whereas with the bank, the times we've tried to refinance at the bank, they've asked for schedule of real estate. We're trying to refinance one property. They'll be asking about all the other stuff we own, or they care about all your personal assets, personal liabilities,
and
personal
some banks
income.
Don't even refinance as well.
Yeah.
So, and it's a 3-month process plus when you find a bank that will, and it's
it's
a bad process.
Whereas with the DSCR lender, another thing too, it does not show up on if someone pulled your credit and you say have 100 DSCR loans outstanding, it does not show up on your credit. I only learned that this last year, but it's great because the loan is big emphasis on the fact that the loan is tied to the property's performance and it's tied to the property and the property LLC you have, because none of our DSCR loans would show up on our credit. If they pulled our credit, they would not see those loans. So that's a really great thing about DSCR. It will not interfere with your ability to get other loans. If you have 100 outstanding DSCR loans, it's not going to cause any problems. The other thing, Mr. I need permit. And you have to own the property 6 months with some banks. Exactly. Yeah. Gabriel. Yeah, they have a seasoning period.
They only lend on like 50% of it the first year, depending on their terms. That's
correct. There's one other thing I was about to say.
Yeah, I'm sorry.
What was it? Yeah, I lost it. Shoot. Lending, credit. Yes, limits. Cam Burke, he was telling me how he's run into a huge issue right now with the banks he's working with, because if you're working with community banks, when you start to become a big enough number on their balance sheet, they get worried and they can just cut you off. If they see like, hey, their loans, their properties are taking up too much risk on our books, they can just cut you off. They can just stop lending to you. They can limit you, especially if you're using local community banks. They don't have as much, they're not as big, and they can't handle as much risk. And if you're getting up in the 10 million range as far as like outstanding loans on properties, which that sounds like a lot, but if you stick to real estate, as like doing the BRRRR method, like a lot of investors get there in 5-10 years doing it full time, but they cut him off. The thing is with DSCR lenders, they have no limit. I literally think our DSCR lender, their limit is like in the, I think it was like, it was like something like 500 billion. Like it's ridiculous. And it's like impossible to reach for, 99.999% of investors, but DSCR lenders will not cut you off. You do not get flagged or they start to stop lending on you when you have too many properties. Because what they do, they basically take your loan and sell it off individually. So it's never like you're not treated as an individual. It's property by property. So that's also why they don't care about underwriting you as much, because they're selling off the property's note to all kinds of different, people. Yeah, the note buyers. I don't know the exact terminology, but that's why you'll run into no limit with the DSCR lender. Next thing. Just skimming through all this stuff, guys, too. I posted in the DSCR loans module. Yeah, the other thing, loan to value, depending on your credit score and the value of the property. LTV, we always just do 75%. Only a few times have we done 80%. Now, if you ever get hit with, do you have the option, do you pull out 70% or do you pull out 80%? There's two things you can check. What's the cash flow if I pull out 80%? As long as you're not negatively cash flowing more than like $100, always take the maximum amount, because that cash you get, that extra, say 10% of equity you're pulling out, you can throw into another deal. In the value creation you can create with that extra 10% is going to be much greater than the lack of cash flow that you pull out by juicing the deal a little bit more. So I talked about it in the module here. Yes, you can close in an LLC instead of your personal name. And fast, speed. Last thing I'll say, DSCR lenders, they're commission based. So they're faster. They're so fast. They want to get their commission. When you're working with a bank, they're working on bank hours. They move slow. We've had stuff outstanding.
Hard to communicate with them as well, only strictly by email.
They give you a hard time, but like DSCR lenders are commission based. They want to get the deals closed. And yeah, so I don't know why it's not more publicly known. I don't know if it's maybe gate kept by some of these, in people online for DSCR, but it's what it felt like. If I was listening to Bigger Pockets, I was watching all the YouTube videos, and we were doing real estate for about a year and never heard about DSCR lenders. And I even talked to our DSCR lender. She's like, yeah, not that many people know about it, but it's what all the biggest investors like Nate Barger.
Yeah, I always thought you just go to a bank and the bank gives you money.
That's like what all the biggest investors use, but I haven't ran into enough of them talking about DSCR lenders. I mean, Nate Barger's being better. He talks about it. He talks about it. He's like, that's his loan product. But for the longest time, never heard about it. And Tony and I were in the real estate space. We were in the Facebook groups. Jaquan didn't even know about it. And he'd been buying deals for like 5 years. And he was trying to tell us to go to community banks. Yeah. Gabriel knows Jaquan. But he was telling us to go to a community bank. And like, we're 20 years old. Like, how the heck are we going to get a loan from a community bank? So yeah, it's just they're so not talked about as much as they should be. And yeah, because I come across too a lot of investors, like even that join this group, that tell me they have a few deals and they're like, I don't know what to do. Like I can't. Like there's people with multiple deals that are trying to do the Burr method who haven't heard of a DSCR lender, and it's like the smallest thing that will shoot your portfolio up, especially if you're buying in cash, like that, because the amount of deals you lose out on if you're using a traditional bank just because of time, like 3 months versus 4 weeks, that's a whole nother house. And you multiply that out over the entire year, that's 3-4 houses. Every one of those houses, that's 40,000 in equity value add creation, and it's compound effect. And so it might not seem like that big of a deal if you're able to get money out from the bank, but even if you're using a bank now, how long are they taking? 3 months to refi, 6 months to refi? What, like, if it's taking you 9 months to refi, in those 9 months, if you had your cash out, that could have been 1, 2, that could have been 3 or 4 more houses if you had a DSCR lender. And that was something we thought about, like, well, the bank might be a little cheaper. We might be able to get a little bit cheaper interest rates, but the bank's still going to take 3 months. In those 3 months, that could have been a whole nother cycle of buying and remodeling a house, creating a value add. Yeah. So that's what I'll end with on DSCR loans. If you guys want our DSCR lender, shoot me a message after this call, and I'll get with you on that. Next thing, we got a deal we're going to go over real quick. But before I go into that, please, everybody drop your questions about DSCR lenders. So I see Sean here. He said credit score matters too. 680, 740 can get you 75%. But if you have great credit like 740, you can get 80%. All depends who you use. Yeah, very true. 680, 740. I have seen Trishelle she does some magic tricks. I've seen her get loans through at like 620. I don't know how always, but she has her magic tricks. But yeah, good point, Sean. That's what will determine your LTV, and your interest rate is your credit. Credit determines LTV, loan to value, loan to appraised value. That's what I'm saying. Like, what is the market value? 75% of the market value versus 85% contingent to your credit score. And then
market value is not what the
interest rate
is as well. I want to make that very clear.
Yes, especially if you're investing in pocket markets, maybe with less sales, less proof. Don't trust Zillow. PropStream's great, or actually getting some data, some real data from the MLS.
Zillow could legitimately be off by $50,000, and it would say a completely different number.
Correct. Any other questions, guys? Drop it in the chat about DSCR loans. I will get to them. But in the meantime, Tonio, what's the deal we got? We're going to break down.
I want to go over the deal that Chad sent.
That Chad sent? Oh, yeah. Yes. Is he even on the call?
Yeah, I think so. I think he is.
Chad's on the call?
Let's unmute.
Let's talk about it. Where is he? No, I'll just all right, so we got a deal that was sent here by Chad Lebedinsky. Lebedinsky. My last name's Vislowski, so I'm sure you and I deal with the same pronunciation conflicts as well. So let's look at the deal he sent us. So
2621.
Yeah, we'll not just, because I don't know if you have it on a contract or not. We won't say the address, but we will talk about the numbers only. We'll talk about the numbers only for your deal there, Chad. And I'm going to open up a spreadsheet and just show you guys how we determine if something's a deal or no deal really quickly. So actually, I'll go to our deal calculator.
Yeah.
So if you guys have not opened it already, deal or no deal calculator. Wait, is this the right one? No, 1 second, guys. You guys have not already. You should watch the tutorial about rehab cost calculator. Okay. This is it. Yeah. I'm going to share my screen. If you guys have not already, get your deal calculator in the module. There's a module, deal or no deal calculator. So this is what we do roughly to estimate. You can have just like a blank spreadsheet. It's not that hard. I've done it before on previous lives, but this deal calculator is available for you guys to use. And this deal, Chad, he sent us. So purchase price, Antonio, can you remind me what he said it was?
He said 70K.
$70,000 purchase price. Okay. Sorry. It's just, so Chad's got a deal for 70. And I won't say the address, but it's in Indianapolis.
It is.
Indianapolis. Okay. Good market.
And I'm just going to assume that he was doing this as a rental.
So we're assuming as a rental, not a flip.
Let's
Well,
go over
total.
Better bath, everything. So
Okay. Yeah. Square footage.
780 square feet.
780 square feet. All right. It's pretty small, but
2 bed, 1 bath.
2 bed, 1 bath. All right.
Let's go down to property taxes.
What do you think the monthly rent?
This market, let's say
probably bump it up a little.
950.
Yeah, let's say 950. Chad, text in the chat if you think that's wrong. I don't know if you know this, if this is your local market or what. Yeah, 1 second.
Yeah, share if 950 is an accurate rent.
Yeah, and then Antonio, we'll see it. Where'd it go? There we go. So at 950, 70,000 purchase. Vacancy rate. Antonio, looking at this, does this look like low income?
It is. I don't think it's going to be vacant very long.
Yeah, Indianapolis is a pretty hot market. Management fee, 8%. We'll leave it. Maintenance reserve, let's bump that to 5%. Because if remodel, did you say he's doing a remodel? $20,000 remodel. All right, so we're going to put him down here. Let's say he's doing 20,000. What's that scope of work? That seems like a pretty low remodel.
Sure, he didn't go over the scope of work, but he said 20,000. He could put $20,000 into it. So
all right, let's just say 20,000. So you're going to be all in 90,000. Property taxes. What does Prop Stream say?
$1,100.
$1,100. All right, insurance. Let's see for property GPT market. Oh wait,
it'd be $1,100.
What about insurance?
Insurance could be roughly the same thing, $1,200.
All right, let's throw in 1,200. If you think we're really far off on that, Chad, please text. We don't know that market. But we got 1,200 for the insurance. Vacancy 5%, management 8%, maintenance reserve 5%. And guys, what this is doing, the formula, all it is multiplying the monthly rent by 5% and then subtracting that from the monthly rent to figure out what our profit is every month. Square footage 780, bed, bath. All right, we got all that accurate. So right now it's saying no deal, but let's see why. We haven't filled in everything. After repair value, what do you have it at, Antonio?
ARV. Chad was saying 130.
130.
There's a house next door sold for that exact number.
All right. So right now it's telling us that it's a cash on cash return. Yeah, sorry guys. There we go. Let's do cash. Let's see why the numbers are looking this way. Annual, owner utilities. So right now we're at a 7.3% cap rate, but I must have something entered in wrong somewhere because it's saying cash on cash return is negative. So just give me 1 second, guys. The cash on cash return. Yeah, monthly rent 75%. See what's going on. 1 second, guys. This is not right.
It is not right.
No. Cash one after repair 75%, 6.8 refi terms 30 DSCR. Why is it saying negative cash on cash return? That's not what it's supposed to look like. Are you editing it?
I'm going on another one.
Yeah. All right. Here, just send me that one. I'll change this one. Sorry, guys. 1 second. So ignoring the cash on cash return, the cap rate is correct. 7.4% cap rate. Here, I'm just going to pull up I'm going to make a fresh spreadsheet just to show you guys how to make it real simple. So $950 is a month rent. All right. Real simply, if you're not using the deal calculator, here's how you can underwrite it. Rent $950. ARV 130. 130,000.
Here, I got it right here.
Purchase price.
I'm not sure.
Yeah, let me just fill this out and then we'll share yours. I just want to show you guys how you can do it real simply because that deal calculator can get a little complex. His purchase price is $70,000. He's going to put in, no comma there, $70,000. His remodel is going to be $20,000. $20,000 remodel. So he's all in. 90,000. Yeah, you got to factor in closing costs. We'll just keep it simple.
Not good.
We'll keep it simple. Yeah, you're getting the same thing. All right.
Negative 10%.
All right.
Cash on cash.
And then his monthly mortgage payment on that one. So then 75%, the cash out refi. Here's what it's going to be. It's going to be one.
Same thing as you were, but
All right. You want to share me that, Doc? I'll share it.
it was the same exact numbers.
Oh, really?
Yep.
All right. 97,500. So he's going to pull out 97,500. So on the actual cash out refi part, not bad, because when he throws in closing costs, it'll be about 4,000 extra, between the refi and all that closing. So we'll be at about 90,000 all in, 94,000. And then cash out refi based on the ARV, he's pulling out 97. I'm just going to say he'll probably be roughly the same with maybe a little bit of cash tied into the deal. But the problem we're running into seems to be with the rent and the monthly mortgage payment on that 75%. So real quick, that 950, what does Zillow say? Does Zillow, because sometimes PropStream can underestimate rent. What does Zillow say rent is? I mean, it's only a 2-1. I don't expect you to get much rent. So it looks like the reason why this is not looking to be a deal is not because of the value add or ARV. It looks to be because of the cash flow after you refinance. So let me just calculate what your monthly mortgage payment would be on that roughly. So roughly mortgage payment on that, let's just say 7%. All right, 97,500 at 7%. It's going to be roughly about.
Could be a deal, actually.
Yeah, let me break it down because let's look at this a little closer. About $650 a month. All right. Okay, so $650. So let me show you line by line here. We got rent, that is $950. All right. Mortgage, I'm going to put down here just to show, so you can watch that cash flow go down as I add an item. So equals sum of. So equal this minus, and again, guys, I will be posting this live in the group after I'm done if you want to go back and look at it. So Chad, you can take a look at it. Equals, sorry. Sum of. All right, there. So after mortgage, so first, all right, you got your rent. This is what you're collecting right now. You got your rent, and then you pay your mortgage. You're left with $300. All right. So next thing, you got management. Okay, let's just say it's 8% management fee. So all I'm going to do is multiply 0.08 times 950. Okay, $76. Now we're down to 224. All right, now let's throw in vacancy. Why are we throwing in vacancy? Because I mean it's lower income.
Something's gonna happen.
It's going to be vacant at some point during the year. So let's put in. I'll be really generous and do 5%. Personally, if it was my deal in our market, I'd do 10% to be safe. But I think you can get away at 5%, and just for the sake of underwriting, let's set it at that and see where we get ourselves. All right, we got 176. Like we said, insurance and then taxes comes out to be roughly $100 a month each.
$1,100 each, so that is.
Yeah, $1,100 each, so a little less than $100. And again, Chad, if you want to do this, if
$183 total.
183 for taxes and insurance. So tax plus insurance. And again, Chad, if this is your market, I would recommend two things. If either find an insurance broker that can give you really good quotes, or your DSCR lender, if they're a good DSCR lender, can get you insurance quotes, because the DSCR lender, a good one, wants your deals to work. So what you'll find is good DSCR lenders got the insurance plug. They got really great people for covering your insurance. And it's what we do. Hope my audio is working. Oh yeah, it is. Okay. All right. So tax plus insurance, 183, negative 650. And then we got repairs, M&R, maintenance and repairs. Let's just say, I'll be nice. I'll do 0.05. So negative $50. It's not a terrible deal. The problem is after the refi, you're going to get your cash out. Like I would confidently say you'll get most, if not all of your cash out of the deal, just based on this. Like you got the value add, it's there. The problem is the cash flow. So
No, I mean, if you could rent it for $1,050,
if you can rent it for $1,050, great. If you self-manage, okay. Vacancy, if you can get it Section 8, lower your vacancy. Maybe it's a deal. Tax and insurance, you can't really do much about that. Shop around insurance, not much you can change. Maintenance and repairs, can't do anything about that. So a negative $50 cash flow deal is not terrible, but typically when we're okay with negative cash flow, we're typically pulling out more than we put in. So I can't say this is not a deal because I don't know what appreciation is in your market, because you could buy or rent growth.
Or if this is the, I mean, Chad, if you could drop a comment saying this is an accurate rent, it'd be better. But I mean, you can see based off the numbers, if you can rent for not $1,050 a month, it's a pretty good deal. You're gonna be cash flowing.
Yeah, but at that current rent, personally, we would not buy it just because we'd be negatively cash flowing. Yeah, but it's really not a bad deal for the value add. But we don't meddle with flipping, because if this is a flip, I don't know exactly who gave you that $20,000 remodel quote, but it'd be more than $20,000, because when it's actually a flip and you go to sell it, you're gonna have to deal with inspections, and it's held to a much higher bar than just a remodel for renting. So look, you got it on the value add. It passes the 75% rule, but as far as rent and cash flow, it's really tight. But if you're self-managing, okay, it's a deal. I would say if you're self-managing, you're breaking even. For us, generally, we don't like to be negatively cash flowing on too many deals back to back. And again, typically when we're okay with negatively cash flowing, we're getting better value add. So if you can get this at a purchase price of like $60,000, so that you can pull out more than you put in, and that capital gets recycled into maybe a better deal, more cash flowy deal, I'd say you're great. But yeah, if a wholesaler sent you this, I'm going to give you guys some sauce on wholesalers that wholesalers would hate me for sharing. But he's at 70. I guarantee you he's at 60. Wholesalers, especially green ones, the first thing they do, most green wholesalers, the way they price their deal, they take what they have, they add 10,000. They don't add more. Yeah, depending. But they don't think too much about it. It's pretty just, I have it at this price. Let me mark it up 10 grand. I want to make 10 grand. It's a skill getting wholesalers to come down to your price. I've seen Antonio bark down at wholesalers till they're only making $1,000, because it's negotiations. It's a skill. It's the same thing you got to use with realtors. And so I think there's an emphasis on the skill of negotiating with wholesalers and realtors. A lot of people put so much time and effort into learning how to underwrite deals and all the different financing and all that stuff. Whereas if they just got really good at negotiating, getting wholesalers to come to their price, realtors, sellers, and they were just a killer at getting prices on properties at the right price. All the other education, you don't need to be a genius on. You don't need to be perfect in your underwriting if you're just a killer at getting stuff at the right price. Because if you buy right, you can make so many mistakes and deals still work. So that's what I would say on this deal. If you can get the price a bit lower or the rent a bit higher, maybe Section 8, I'm not sure in your market, it's a deal. But it's close. It's close, but I bet what the wholesaler has it at, I bet it's a deal there. I would bet.
It's on market too, I think. So I think you just got to hand that the realtor, but that's just for the seller to say yes or no.
Yeah, so let me go back into live with you guys. All right. Questions. Not confident on the rent for this house. Realtor was going to get back to me. Also, I wasn't planning on renting this. Just wanted to wholesale the contract and see if it'd be worthwhile to have another buyer take over and sell around 130. Yeah, so 130 before the remodel, heck no. Terrible price. At 130 before the remodel, no. I say wholesaling it at 70, maybe. Unless
That's still hard.
It's just so tight. But if you wanted to wholesale this deal, dude, honestly, if it needs a remodel, $20,000 remodel, I would say if you're trying to wholesale this, you got to get it at 60, and maybe you can convince a buyer at 70. That's what I would be thinking. Most investors, unless you're working with, for some reason, someone dealing with 1031 or just a really big buyer, most buyers aren't going to be paying that.
That's retail.
Yeah.
70 is still pretty much retail.
Yeah. But again, it looks like it's on the market. I don't think we've ever gotten a wholesale deal on the market. The easier it is to find the deal, the crappier the deal is probably going to be. If it's on the market, way too many people have already seen it, probably not going to be a wholesale deal. If you literally physically door knocked and left a note and followed up with the person for 6 months, probably going to be a deal. So we don't teach too much about wholesaling, but quick word of advice on that: the easier the deal is to find, the less effort you had to put into finding the deal. Probably not gonna be as good of a deal. Most deals happen in the follow up, and you got to get in the trenches, lowballing, finding it. But anyways, if any of you guys saw me underwrite that deal and you want to buy it, I guess it's on the market. So
Do not recommend buying.
Don't recommend buying it, but yeah, at a lower price though, it could work. All right, that covered our bit. Look, any of you guys got comments?
We got a little bit of time for.
Yeah, we can open it up. Yeah, so if you guys want any questions, you can drop it in there. But we'll bring on Gabriel. Let's talk about some deals, Gabriel, you're doing right now. Let's get him on here. Camera. How do I allow audio? Allow video. There we go, Gabriel. All right. So, guys, this is Gabriel. I've talked about him a few times. I think I've even talked about him in the curriculum a few times, but I was talking about it before we started going. Basically, I was first introduced into Gabriel when we were a wholesaler. Yeah, sweet. So when he was a wholesaler, and not really a wholesaler, we were just strictly wholesalers, and Gabriel was the guy running the group chat for our market, and he was just kind of the plug for buyers.
That's
For
what
stuff
we
like that, yeah.
first came to.
And yeah, we hit him up and we said we got, like I would just send him deals, and we did our very first wholesale deal was through Gabriel, and
Gabriel actually bought it.
yeah. I think Gabriel bought it. Yeah, bought it. The first
1413 Northwest Taft.
Yeah. It was he bought it for $7,000, guys. So talking about,
was it 7 or 5,000?
it was 7. We had it at
7.
5.
You guys had it for 5.
5,000.
But guys,
I sold it for 95.
Yeah. So guys, like if you're a wholesaler, like those are kind of prices that like if you're a wholesaler, you got to get in the trenches and find deals like that. We had a contract to buy a house for $5,000.
That's insane.
Yeah. $5,000. Hey, but Gabriel got it for 7. He got a good deal too. So that's why like I really emphasize like wholesalers are the plug. Because like Gabriel's first deal, he got it for $7,000. He worked on it for about a year because I know you said you were working on and off, but still made a fantastic deal. But then after that, Gabriel still kind of was. There's a thing called like JV or daisy chaining and wholesaling, and that's basically was our relationship with Gabriel for a little bit. We just sent him a deal. He knew all the investors, plug them into deals. And then what it turned into after we started buying, Gabriel started remodeling our stuff. We were doing that for a little bit, and we eventually pivoted away from that. And we slowly watched Gabriel start to buy more of his own deals. And it was like we stopped doing remodels with him for other reasons, whatever. We got busy elsewhere, just, logistics. Let's just leave it at that. And then we came back. All of a sudden, Gabriel was buying all of our deals. We're like, dude, like you're going to be our biggest buyer. But long story short, we've just gotten to watch Gabriel grow over the last 3 years from just like, look, he was just working running stuff in the Facebook group, borderline still like doing day labor. And now he's like, shoot, how many houses you got now?
I don't know, man.
Like
Probably
ballpark.
around 40.
Yeah, like dude, it's crazy because it's only been 3 years. Like 3 years ago, you pulled up in your what is that? The Toyota Sienna? What is it? The van. It had like
Toyota Sienna.
Yeah, the Toyota Sienna, and like he pulled up, and like the first time I ever met him was at a deal like we were trying to wholesale, and like, he pulled up in that thing. I mean, he had his reasons for the van because it worked good for transporting. What was it, sheetrock? You could fit like a ton of. Yeah, so he had his reasons. I was like, who the heck is this guy? Like,
they're like, this guy's not buying nothing. Look at the car he's driving.
Like no fun. He pulled up looking a little bit like a bum. But 3 years later, that's the crazy thing of real estate is like literally the only input that matters is just consistency and sticking to it. Because it's just been sick to watch. Like, dude, like what the heck?
And
like,
we've probably done close to 100 deals together if you think about it. From all the deals
probably
close to 100.
Yeah, but it's just nuts because like guys, like it's real estate's idiot proof is what Antonio and I say all the time to each other.
Exactly.
Like, it's idiot proof. Yeah. You just keep buying. And Gabriel actually has this saying like the seed a lot of people, your income is the seed. You're supposed to plant it in real estate, let it grow, and then you eat the fruit. Most people eat the seed, but it's a really simple concept. And I think Gabriel's a good
Exactly.
example of that. Is like he made his income from his remodels, his wholesaling, whatever he did. I know he's got a lot of side hustles and other businesses, but then he just kept buying real estate. For a while, he's just buying in cash, like we talked about. He had 10 houses bought in cash, and then he discovered lending and borrowing money, and then he just went oof and bought 40 houses. And it's because like he put the seed into the houses for a really long time, and he could have easily been spending that income elsewhere. But like that's really a good point and good lesson and like good
I
thing for
still,
us.
I still have the Toyota Sienna.
Yeah, you wrapped it though. You wrapped it with We Buy House.
Yeah.
How those trucks bought now, just with the
Yeah, everywhere. So in our market, you'll see them everywhere. But yeah, guys, it's just it's only been 3 years, and I think Gabriel, you could probably speak to it. Like year one, you just feel poor because you're just buying houses all the time. You just feel poor. Year two, you probably still
It
feel
is.
poor.
It is.
Year
Like sometimes you purchase like 3 houses in a month, 4 houses in a month, and you're like,
you have
man, where's all my money going? But then
yeah,
like in the long run, you're gonna see that, you have enough wealth for your whole family, like for three
yeah.
generations or something.
And Gabriel, you got a lot of mouths to be. You want to have what, 7 kids, right?
Exactly. I already
Yeah, you
have
just
one.
Yeah, you had it. Gabriel had his first, and I honestly swear, like the saying with a baby comes a basket of bread. After Gabriel had his first kid, he went nuts. That was when it seemed like he was buying like 4 houses off
Yeah,
us
no,
every month.
legitimately was. He had a kid. He called me up. He's like, "Dude, I need houses."
I need to make
I
more
swear,
money.
within 1 month, it was like 4 houses gone. Net, we made a lot of money off of Gabriel, but he also made a ton of money off of those houses. So like, that's how our
Yeah,
relationship works now, and it's pretty awesome.
Yep.
it's so simple, guys. Like I will say, like I think Gabriel's had more success than majority of the investors I've met when I go to when I go to Oklahoma City and I go to a meetup. There's like this problem of investors that seem to know everything about real estate, but they barely make any money in real
Exactly.
estate.
And then you ask them what's their portfolio. They have like 3 houses.
Yeah, or like
Yeah, but they know everything. And
Yeah.
the thing is, like, Gabriel, I mean, it's the best way possible. Like, I think you were probably on like house 10, and there was like basic terminology that like maybe like we were walking a deal, and I feel like there's like basic terms. You're like, what are you talking about, bro? And it doesn't matter. Like that realtors are the worst about that. They love their terminology, and then they'll do barely any deals. And like Gabriel, like perfect example. Like he knew nothing about even like the lending side because he couldn't get lending for other reasons and stuff like that. Like we couldn't get lending, similar reasons. But like he doesn't matter. Like if you know the terminology, if you know the acronym and the slang, like can you find deals
Oh,
consistent?
a
Can you
good
remodel?
example. A good example for people that don't have good credit. If they have like a partner that has good credit, they can still make a deal. They can still get the DCR, the DSCR lender.
But I just think it's I think it ties to the concept of signal versus noise. Like signal, the example is like, all right, if you're looking at the market, and you're looking at it on a 1 day basis. It's going up and down. It's impossible to figure anything out. There's so much noise. It's hard to tell like how is the market doing. Like the S&P, you look at over a month, still a lot up and down. You can't tell 2-3 months, and the longer time frame you look at it, the more clear the trajectory is. And I think that example applies to real estate with the noise being what's the market doing today? What's knowing the different terms and like all the little details of the contracts and like getting so lost in the weeds versus the few things that actually matter, which is how are you finding discounted off market deals or just discounted market deals, period? Like how are you getting them? Are they discounted? How are you funding them? Are you using cash? Yes or no? If you're not using cash, you're funding. How expensive is it? Is it at least decent enough so you can control and remodel and add value? um, long enough to get to the 30-year loan. And that's it. Finding funding and then executing, like the remodel. But I just think so many people get distracted because, especially on the internet, there's unlimited information. And I swear, some people like it's.
You just have to keep it simple.
Yeah, people. I feel like
Keep
it
it
like
simple.
it feels good being busy, and I feel like some people just love feeling like they're being productive, and they're like, oh no, I'm investing in
Yes.
education. I'm investing in my mindset when like just find more deals, underwrite more deals, and just jump in it. Like you will not learn an ounce of how much you would learn just starting your own deal.
There's a lot of people, they're like everywhere, you know. They're listening to Grant Cardone that's telling you to buy like 32
Oh,
units at once, and then they're listening to Dave Ramsey that's telling you to buy everything cash and not finance anything, you know.
yeah,
You just gotta focus on one thing.
yeah.
I think
That's the
that's
big
like the most important thing, you know.
yeah. Focus on one thing and filter the noise from what actually matters. Like you don't. I mean, like Antonio and I, like we'll work with realtors, and they'll say so many terms. We're like, what?
It literally happened 2 weeks ago. Like this realtor was saying, hey, he's a good friend, and he was just saying all these terminologies, and I said, man, just keep it simple. Like
I don't know
write
what
me
you're
the
saying.
contract. I don't know what you're saying. Just the deal is done, but I have
Yeah.
no idea what you're telling me.
Yes.
Let's get it done.
Yes, do it scared. Correct. Like honestly, every time we have been like anxious, really uncomfortable, or scared before doing something, it always works out. And like honestly, nowadays, the thing that I feel anxious and uncertain and nervous about, I'm like by default, like that's what we have to do because every time it works, like you just have to jump in.
And as you learn so much that you wouldn't
Yeah.
learn unless you did it, and it's
Yeah.
good to do.
And like the thing is, like it looks like as it doesn't a bad thing only looks like a bad thing when you're in the moment. But like I think about the worst things that happened to us, a year and a half, 2 years ago, that felt like those worst news ever. Worst news ever. Like how are we gonna like this is terrible, like we're ruined, like whatever. And you play out the events that happened after that, and that was actually the best thing that could have happened to me. So that's another big thing on that. I was curious what you guys' current operations look like in terms of Burr, like housing is relatively automatic for you guys. So I wonder how many people you have on your teams that's worked with you. Also, do each of you spend most of your time doing? Yeah, I'll answer the first part. So question in the chat. What your guys' current how many people? So our pipeline looks like this. So first, it starts with all our marketing efforts to homeowners. That is just finding anybody who says yes to the question, would you be interested in an offer on your home?
That's just
The people who say yes get fed right to Antonio.
Someone else and then to me.
Yeah, so it gets funneled to our follow-up specialist who qualifies the lead from just like a tire kicker versus someone like, hey, they really want to sell their house. Our marketing operations, SEO, PPC, SMA, cold calling, texting, signage around town, all of that. That creates leads. People saying, yes, I want to sell. Follow-up specialist filters it, sets up calls with Antonio just with motivated sellers. Then Antonio.
People that are ready to say, I want to sell my house. I like dealing with those people because it's very easy and I just enjoy doing it. And that pipeline is, 20 to 30 people a day that I'm constantly following up with.
And they're ready to, like most of them are ready to go. Antonio locks them up at a super big discount. Get it under contract. Our assistant, Lindsay, sends the contract.
Correct.
Gets it locked up. Lindsay sends to the title company. Title company, they process, handle all of it. And then for us, once we have the actual deal locked up, we're either wholesaling it to investors like you guys in the community, which huge shout out to Amanda, Andy, Demaya, Gabriel Patel. I mean, not Gabriel, Yug Patel. And that's it right now. You guys have been buying it. Great. We have other investors in our market who buy it. And then the deals we buy, right now we're slowing down. We're trying to just do about
2 a month.
2 a month. Yeah, we're slowing down. If we are buying it, the cash has already been allocated from a previous refi. So when it comes time to buy, I'll just talk specifically deals we're doing. When it comes time to buy, the funds are already allocated, ready to go into account for the purchase and remodel.
And for payroll.
And for payroll for our GC. So we used to be really bad. We used to come up to a closing. We wouldn't have the funds because we were waiting on a previous refi. But now we do not flip the switch on to start buying until we have a refinance closed and the cash ready to go. We do not try to secure lending during escrow. Escrow is the time between getting under contract and when you actually close. We close on the property. Our GC, they handle everything from there up until it is complete. And then the remodel GC handles 4 to 8 weeks. And we are not involved in that basically at all. Lindsay, again, back to our assistant, she handles coordinating with the GC to make sure they get paid, they're buying material, they're on time, they're doing the accounting right. For our accounting process during all of this, gets sent to our assistant, Lindsay, the GOAT, for keeping that together. And then basically between Lindsay and the GC, and Tony and I don't want to hear about it. Like, we're not involved.
It just
I go out and
too much
check out.
time and then
I check him out every Sunday because it's quiet. And I go out and I check out all the projects. Right now, we only are doing stuff for investors until this refinance closes, I believe, next week. And then we're back on a buying spree. And then once the remodel is complete, come about the week before the remodel is complete, we send it to our lender, get the refinance started, because the quicker we get our cash out of the deal, the more deals we can do. And that's been a new thing for this year. Get your cash out of the deal as quick as possible. You'll scale so much faster. So that's now, as soon as the remodel is like almost done, start it. GC finishes, hands off to our property manager, Madison. Madison then takes it. She does the final walkthrough. If there's any little stuff like she finds a leaky pipe, stuff like that, she coordinates with our GC, Barbara, to make sure it's all taken care of. And Madison handles it. And then we tell her, like, hey, let's try to get Section 8 if it pays more or pays equal. If not, like, just list on the market. She knows the deal. Then we meet with Madison on a weekly basis if we have a lot of moving parts. Now that our portfolio is pretty much occupied and we're not really moving around. We do more so like bi-weekly. And she handles the management. She handles tracking the expenses, all of that stuff. And she gives us a deposit bi-monthly.
And Lindsay has a very nice P&L sheet for us.
She keeps track of the bookkeeping. Everything. And then for our accounting systems, we outsource that. One of the biggest mistakes we made, we tried to hire an accountant. We wasted $9,000 on that freaking guy because we were paying him $8, 16, 24, $32,000. We wasted $32,000 trying to hire an accountant who wasn't even a CPA. We are stupid, so stupid. One of our biggest mistakes. A $32,000 mistake with money we did not have at the time.
No, we did. We just wasted it.
Well, yeah. Well, what I mean by money didn't have by paying him, we got rid of our runway, so we had no buffer in our expenses. And now we outsource to a CPA, but the CPA is having to do so much backdating. I've talked about this before. She's having to do so much backdating, so that's gonna be another $20,000, $30,000 bill. Sucks, but now, because we got Lindsay.
How much do you guys usually spend on like accounting every month?
Now it's not much. Now, like,
we just spent $30,000 this past 3 months on it.
Yeah, now because Lindsay's upkeeping and reconciling the books regularly, all we have to pay is for yearly filing, $400 a year. And we're getting rid of all the individual LLCs. Another big mistake was
the attorney told us to do it.
Look, yeah, like in my defense, Zach Cole, I swear, called us out on it. Like he saw my video, but anyways, we are not doing that anymore. One LLC that owns the properties, not individual, because the bookkeeping is a nightmare and it's so expensive, guys.
But we only learned this literally by like all the questions you asked. We learned it because we messed up at some point in the business.
And like, don't be afraid to lose money. Like, there's this concept, I forget. There's a better explanation of, like, sometimes the tighter you hold on to money, the harder it is to attract more of it. Sometimes that's the flow.
Yeah, I mean,
so like we lost a lot, but it comes back in tenfold. You know.
For us, the money was coming in, but it was going out even quicker. So.
But as far as the number of people we work with, we have a team of VAs that do a lot of work, but our total team is right about 20 people. The VAs, some of them are part-time, but our total staff, about 20. As far as actual boots on the ground staffing, it's under 10. The title company, I don't really count it. It's Jen, Alyssa, Kate in the office, and then they have some interns that work with them. But that's kind of a partnership. We're not really involved in the day-to-day. But as far as our actual operations for the Burr, like 10 VAs and then under 10 boots on ground in Lawton. And then we have one more question. Also, what did you spend most of your time doing in relation to the business? Antonio, he's constantly closing deals, and on my end, I'm on the back end. I'm trying to tighten up our systems, SOP, and a lot of it's been trying to grow this community.
The next steps.
I'm kind of focused on the next steps, and a lot of it is growing this community, growing our investor pool, and tightening that up.
What do you guys think about development?
Development,
I don't know
Again,
too much about.
I don't know.
I can't speak too much about
I
it.
think
That's not my niche.
I think about like how many mistakes like we would make getting
Yeah.
into a new thing like development. Like I know the money's
Yeah.
there, but I'm not smart enough to know how to build a house from the ground up. Like why break what works, you know?
And another thing too, for your question, you were asking what we do. It's really nice having a partner that doesn't do what you do or like what you do,
Yeah.
because he does his own work and he gets to scale a different side of the business that I per se don't like to do, and it goes vice versa. So it works amazingly.
So Gabriel, what's your day to day? What's your systems look like these days? You got 40 houses, you do remodels and all that. What's your day to day look like?
Ah, man, I wake up, I come over here to the office. There's a bunch of emails to reply, a bunch of wholesalers sending me deals.
Yeah.
But most of these wholesalers, they're like out of state wholesalers, so they don't know the market like you guys do,
Yeah.
you know? So they're sending me a deal like on the middle of nowhere, that the crappy neighborhood, and they want to make like 50 grand on it. And I'm like, bro,
Yeah, we see it all the time.
And Gabriel, where you save
literally today, one guy, I don't want to say the address, but man, the guy wanted to sell the house for 130. You know how much the ARV on that area is?
products,
105.
yeah, it's great.
Yeah.
The ARV.
And Gabriel, where we save money at is getting deals like in house, since we do all of our own marketing. But you save money on all of the renovations, correct?
Exactly,
Yeah.
exactly. Like there's a house that you sold to me. I don't want to say the address, but there's a house that you sold me, and I didn't keep because I was needing some more money, you know.
I remember.
So I just remodeled it a little bit and I wholesaled it, you know.
Yeah.
And the investor contracted me to do the
Yeah.
work,
Yeah.
to do
Yeah.
whatever was left, and I make money over there as well, you know.
Hoover?
No, Lindy.
Lindy, I see. Okay. Oh, I
Yeah.
remember. Yes. We made a video about it actually.
And that's one thing. Yeah, your favorite person in the world, Patrick Gabriel. One thing he told me is to be a full time. When you become a full time real estate investor, you need to make a decision. Like, are you gonna? What's your thing gonna be? Is it gonna be you find your own deal so you get a discount there, or are you gonna start doing your own remodels or like really getting involved in the GC when you become full time? Because he talked about Shelby, because he not Shelby, Naomi.
Naomi.
Talk about Naomi. She's a part-time investor. Her husband works full-time. She invests. She
And
gets
she's
deals.
investing full time now, though.
She's starting
Yeah.
to invest full-time, but she gets
Full-time.
deals from us, and then she has been outsourcing the GC, the remodel work for the last few years. But now they've been doing it for a few years, and she's making the switch to full-time. The area she picked was learning more about the remodel side and like
Correct.
getting her own GC.
Yeah.
And so on that, yes, you can outsource to wholesalers and realtors, find your own
And she
deals.
saves money as well on the realtor side because of her husband. Her husband's a realtor.
Because her husband's
Yeah,
a realtor.
exactly.
And so that's what I'll have to say is for your first, say, 5 years, if you're part-time investing, yes, use wholesalers, realtors. Yes, outsource your remodeling because it's part-time and it's fine and you'll grow. But the day you start to switch and be full-time investor, you make a choice. Are you going to become an expert at finding discounted deals and outsource contractor work, or are you getting involved in the contractor work or even the property management? But that's a piece of advice he gave to us because when you start to scale, you want an area where you start to pool in-house and save money because it becomes big numbers when you start to get past 20, 30, 40 doors.
And after you start buying like deals constantly, like you'll make a deal with your GC. You're like, hey, I'm gonna give you another house next month, so give me a better price, you know, a better deal.
Yeah, exactly. It compounds.
So
And that's what comes in time. Like, but in the beginning, you're part time. Look, if you're earning more than 10% on your cash, you're beating 99.9% of people because most people aren't even investing. Period. So if you figure out, like, like that's the thing. Like we're just if you're getting anything above 10% on your cash in on a deal, you're winning. So like don't get too if you're on social media, you might see people being like, well, we have our own property management company and own GC, and we're making money here in the back end, there and there. And it can make you feel maybe insecure or feel like you're doing something wrong. You're not doing something wrong. Like if you're earning more 10% on your cash, you're in the 1% period. So don't stress too much about that stuff. Yeah. Well, I don't have anything.
how long is a deal for you guys usually taking, like for the whole process?
4-week close, 4 to 8 week remodel. 4 to 8 weeks, that's the range we give because depending on stuff, say we got to get a electrician out there, maybe like, HVAC installing. There's little stuff that can come up that can delay things, maybe where we need to get a permit or license.
Yeah.
4 to 8 weeks on the remodel, 4 weeks on the refinance. So our best case scenario, like our bread and butter, is between the day it goes under contract to when we refinance is 3 months. That's awesome, because 4 of those
Yeah,
weeks
that's good.
escrow. That's best case scenario.
Literally
3
4
months,
weeks.
you imagine 3 months, you pull all your money out and you're buying another deal with the same money.
Yeah, that's like our best.
Like, man,
Stuff happens though,
And it's only 3 months because 4 weeks is dead. It's dead. So like
when it's out the title.
it's a title company for 4 weeks. They're doing the title work and abstract. So,
but that's what we're trying to make the standard be. But we're not perfect, and we still have a lot more systems to improve and all that. But that's like what our goal is. 3 months between the day it goes under contract to getting our cash out of the deal. 3 months. Because the shorter you get that cycle, the more deals you can buy.
And when you're doing 5, 6, 7 deals a month, it's a lot of cash coming in and out.
Yeah.
yeah.
What about you, Gabriel? What's your finance? I know you're using a lot of private money. No?
Yeah. And I'm also JVing on a bunch because, like I told you guys, I'm still working on my credit. So I need people that has better credit than me to go on it with me on the deals.
Yeah.
Yeah.
Yeah, it's a good system.
I mean,
right now though, I mean it's crazy. It's every
but
single week.
I have a bunch of deals by myself too. So
A ton.
Just cash. Yeah, but then as soon as you get your credit up and you start using DSCR, like those houses you bought in cash, like you're gonna be
exactly.
nuts. It's gonna be nuts. Yeah.
Crushing it.
So, all right, any other
Exactly.
questions? Went a little bit over. Yeah, that's all we got, guys. Again, if you guys have any questions, post in the general discussion. If any of you guys want, we're testing the waters of some one-on-one stuff. If you're interested in working one-on-one, Shemaya, Amanda, Andy, Yug, a few you guys already doing it. I think it's going pretty well. And you guys
always join these free lives too. You get, this is a ton of stuff that not many people get to hear, like the insights. So join us every week.
But yeah, if you guys are interested, we're testing the waters of some one-on-one stuff. We're capping it though. We're not just open the floodgates. Shoot me a message if you'd be interested in any of that, and I'll send you some info. And well, happy Wednesday, guys. Got any questions? General discussion. And again, this is Gabriel. If you guys have remodel questions, feel free to at him. He's a remodel guy. He knows more than us. At him in the chat, that is, and he'll jump in there and answer your questions. But anyways, I will see you guys next week.
All right.
All right. See you guys.
Gabriel, I'll call you later. See you, everybody.
All right. Bye.